Welcome to The Explainer. Today, we're bringing some serious energy to a debate that has absolutely raged at barbecues, in break rooms, and across finance forums for decades. We're taking a hard, data-driven look at two radically different investing strategies. On one hand, you've got the thrill of the hunt, keeping your cash ready to pounce on massive market dips. On the other hand, we have the absolute, utter boredom of dollar-cost averaging, just investing a set amount of money regularly and completely ignoring what the world is doing. So let's dig into the math together, because what we found absolutely shatters some deeply held beliefs about how money actually grows.
I mean, it's the ultimate fantasy, right? What if you only ever deployed your hard-earned cash when there was blood in the streets, when everything was just on a massive discount? It sounds like a surefire way to build incredible wealth. But is it really? Over the course of this explainer, we're going to use 4 decades of hard historical data to uncover the surprising answer. We're going to strip away all the emotion and just look at the raw numbers of what actually happens to your portfolio when you sit around waiting for the world to end.
Okay, let's dive right into this. Section 1, Cole versus Carol.
Let's set the stage with 2 completely hypothetical investors, Cole and Carol. They're the exact same age, they have the exact same job, the exact same paycheck, and they are both starting with $0 in their accounts. They each have $300 a month that they can comfortably afford to invest, but their approaches, they couldn't be more vastly opposed. Cole is disciplined, but in a very specific way. He's sitting on his pile of cash, keeping his powder dry, just waiting for the next big crash. He kind of views the market like an escalator that occasionally collapses into a fire sale, and he wants to be there when it does. And Carol? Well, she just tosses her $300 into an index fund on the first of every single month. She's on absolute autopilot. Market at an all-time high? She buys. Headlines predicting doom? She buys. She is arguably the laziest investor alive. Look, on paper, one of these people is using their brain and the other one is using an automatic bank transfer. Cole's plan just sounds so much more intelligent. Buy low. I mean, it is literally the first rule of investing. Carol's plan sounds like she isn't even trying. She's buying on objectively terrible, highly overpriced days, and she's doing it on purpose. One of them is acting like a Wall Street genius. The other is just letting an algorithm do the work. Over a 40-year race, intuition tells us the genius wins for sure. But hold on to that thought, because intuition is about to hit a brick wall. Moving on to Section 2, the cost of waiting. So what actually happens out there in the real world as Cole sits on the sidelines waiting for that glorious discount? Well, 11 straight years. This number right here is the biggest flaw in the whole buy the dip fantasy. From March of 2009 to February of 2020, the stock market climbed for nearly 11 consecutive years without a single bear market. And during that stretch, it returned somewhere around 400%. Just picture Cole during this whole run. His cash is just sitting there in a savings account. He's muttering to his friends that the market can't possibly keep going up. His metaphorical truck, the one he was going to back up and load with cheap stocks, is literally just rusting in his driveway.
And honestly, the reason Cole is struggling so much is sitting right in front of us. Historically, the stock market is positive in roughly 3 out of every 4 years. So when Cole decides to sit in cash and wait for a crash, he isn't betting on a 50-50 coin flip. He is betting against a heavily loaded coin, over and over again, and he's using his own financial future as the stake.
Let's actually break down the math of this upward grind. Since 1950, the S&P 500 has closed at a record all-time high on roughly 7% of all trading days. But here is the kicker. Almost a third of those record highs became permanent floors. The market simply never dropped below that price ever again. So for Cole, the whole strategy to wait for a dip usually translates in practice to waiting for a price he will literally never see again in his entire lifetime. Carol, meanwhile, is just letting compounding do the heavy lifting every single month.
All right, Section 3, the godlike timing study.
Now, what's really interesting about this data is, what if Cole eventually gets his crash? What if he pounces in one heroic move and makes it all back? We can actually test that theory with a fascinating 20-year study by Charles Schwab, and the final totals are just shocking. Schwab tracked investors over 20 years. The first was a literal god of market timing. They magically bought at the absolute lowest perfect day every single year for 2 decades. They ended up with about $186,000. Then we have Carol, our mindless autopilot investor who just fed the money in evenly as it arrived. She finished with $166,000. 20 years of absolute literal perfection barely beat a woman who forgot her brokerage password. And Cole, the patient genius keeping his powder dry, He finished with $47,000, barely a quarter of what Carol made.
And if that wasn't a big enough kick in the teeth, check this out. Schwab tested a fourth investor, the unluckiest soul imaginable. This person bought at the exact peak, the worst possible day every single year for 20 years. That cosmic disaster of a portfolio still tripled Cole's cash waiting strategy. Being in the market on terrible days was just a rounding error. Not being in the market at all was an absolute catastrophe.
And this brilliantly illustrates what happens when you stretch that gap across an entire lifetime. $100 dropped into the market back in 1928, ignoring every crash, war, and depression, would be worth well over $1 million today. That exact same $100 kept safe in cash the entire time, it's worth about $2,500. It is the literal difference between generational wealth and, a nice dinner out. Now, let's take it even further. Finance writer Nick Moduli ran an incredible study where he gave the dip buyer a crystal ball. He created an all-knowing strategy that saves cash and deploys it perfectly at the exact lowest point between any two market highs. Literal perfect foresight. He ran it across every 40-year stretch going back to 1920. When I saw the result of this, I was stunned. The boring, mindless monthly investor beat the all-knowing god of market timing more than 70% of the time. Let that sink in for a second. Even with perfect knowledge of the future, the dip buyer usually loses.
But here's the catch. The moment you introduce human error, the entire dip buying strategy completely collapses. Moduli found that if our all-knowing dip buyer misses the exact bottom by just 2 months, the boring dollar-cost averaging strategy wins 97% of the time. You drop from a 30% chance of winning to a 3% chance, just by being off by a few weeks. And let's be real humans aren't off by a few weeks, they're off by a country mile.
Which brings us to section 4, escaping the trap. So the crucial point is, beyond the sheer mathematical disadvantage, there's a massive psychological cost to trying to outsmart the stock market that almost nobody talks about until it's too late. Why does the dip buyer lose so consistently? First off, your cash earns basically nothing while you wait, and the market is drifting upward the whole time. Second, those perfect bottoms you're waiting for are incredibly rare, and they almost always sit at a higher price than where you could have just bought a few years earlier. Third, a true 20% plus bear market only comes around roughly every 3.5 years. You're basically waiting for a bust that might not come for a decade. And finally, buying when everyone else is panicked is psychologically terrifying.
Let's look at the actual data on how humans behave. A research firm called Dalbar tracks how investors actually act in the wild. In a recent year where the market returned roughly 25%, the average equity investor earned around 16.12%. They left over 8 percentage points on the table in a single year. Why? Because they didn't buy the dip. When the market got scary, they panicked and pulled their money out. The dip strategy requires you to be perfectly calm, rational, and aggressive right when human beings are biologically wired to be terrified, frozen, and selling. You literally have to be a robot. Which brings us right back to Carol. Her quiet, beautiful secret was that she never gave herself the chance to be smart, which meant she never gave herself the chance to be wrong. She didn't have to be brave during a market crash because she was already buying. She didn't have to call the bottom because she bought all the way down and all the way back up automatically. She removed human emotion entirely. She turned the absolute scariest financial moments into her very best purchases with zero courage required. And the cleverness Cole was so proud of, that ended up being his most expensive liability.
So as we wrap up this explainer, we are left staring at the ultimate trap. And that trap is believing that there's some perfect moment out there worth waiting for. The truth, the data just screams at us, is that the moment is always right now. The next time you find yourself, or maybe a friend, keeping cash on the sidelines, waiting for that better entry point, I want you to ask yourself this final, provocative question. How long are you really willing to wait? Because the market doesn't owe you a crash. And while you sit there waiting for the perfect moment, the only thing truly compounding is the cost of waiting.